You click this because part of you is worried. Not about Bitcoin. You believe in Bitcoin. You are worried about what happens if life forces you to sell it before this cycle plays out. That fear is not weakness. That fear is wisdom. Because most people who lose in crypto do not lose from a bad trade. They lose from a broken roof, a medical bill, a job loss. They get caught without cash, and they sell the asset that would have made them wealthy at exactly the wrong moment. Today, I am giving you a mathematical system that makes sure that never happens to you. It is called the 80-20 rule. By the end of this video, you will know exactly how much cash you should be holding, why holding it is not a mistake, and what it costs you in real dollars if you ignore this. Here is what most Bitcoin educators will never tell you. The bear market is not what destroys portfolios. What destroys portfolios is a liquidity crisis arriving at the worst possible moment. Let me show you the math. Pay close attention here because this is the insight everything else builds on. You are holding 0.5 Bitcoin. The market has dropped 50%. Bitcoin is trading at $30,000, and your roof fails. The repair costs $1,500. You do not have the cash, so you sell. You sell 0.05 Bitcoin at $30,000. You get $1,500. The roof gets fixed. Except 18 months later, Bitcoin is at $100,000. That 0.05 Bitcoin you sold is now worth $5,000. You paid $1,500 for a roof repair? The true cost was $5,000. Because you were not selling Bitcoin, you were selling your future. That gap, that $3,500 difference between what you received and what you surrendered, that is called sequence of returns risk. It is the real enemy. Not the volatility, not the drawdown, the forced sale at the wrong moment. And here's the question worth sitting with. How many forced sales are hiding in your life right now, waiting for a crisis to trigger them? Smart holders do not try to eliminate risk. They architect around it. That distinction matters. And it is the entire foundation of the 80-20 rule. Here is how it works. 80% of your investable assets go into hard assets. Bitcoin. This is your long-term wealth engine. You do not touch it. You do not sell it when the market drops 40% and your neighbor is panicking on social media. The other 20% is your liquidity buffer. Cash, short-term bonds, or stablecoins. And it covers 12 to 24 months of living expenses. That is the whole system. 80% protected, 20% liquid. Here's why it works where everything else fails. During a bear market, income can tighten. Expenses do not stop. Cars break, medical costs arrive. If you have no liquidity buffer, every one of those events is a direct threat to your Bitcoin position. But if you are sitting on 12 to 24 months of expenses in cash or equivalents, none of those events can touch your Bitcoin. You draw from the buffer. The 80% stays completely untouched. You ride the bear market out in full. You do not just survive the drawdown. You own more Bitcoin at the bottom than you did at the top because you never had to sell a single Satoshi. Think about what that means when the next cycle peaks. Now, before we go further, I need to address something directly, because some of you are already feeling resistance to this idea. There is a voice in Bitcoin culture that says, cash is trash. You have heard it. Maybe you have said it. The argument is that any dollar sitting idle is melting from inflation, that real believers go all in, that holding fiat signals weak conviction. Here is what I will tell you plainly. That voice is wrong, not philosophically, financially. Holding 20% in cash does not mean you lack conviction in Bitcoin. It means you understand capital allocation. It means you have moved from the gambler's mindset into the strategist's mindset. Gamblers go all in because they believe conviction is measured by concentration. Strategists build positions they can hold indefinitely because they have engineered out every reason they might be forced to sell. You are not a bad Bitcoiner for holding fiat. You are a smart capital allocator protecting your position. The Bitcoin that survives a full bear market is the Bitcoin that builds generational wealth. And you cannot hold what you are forced to sell. The 80-20 rule gives your Bitcoin the structure it needs to survive long enough to do what you believe it will do. Here is how to actually build this. Step 1. Calculate your real monthly expenses. Be honest. Housing, food, transportation, healthcare, and a contingency for the unexpected. Most people in this audience land somewhere between $4,000 and $10,000 per month when they do this honestly. Step 2. Multiply by 12 for your minimum buffer. Multiply by 24 for your target. Step 3. Hold that amount in liquid, low volatility instruments. A high-yield savings account works. Short-term treasury bills work. Stablecoins if you are comfortable with them. The goal is not yield. The goal is access. This money needs to be available without friction when life happens. Step 4. Everything above that number goes into Bitcoin, held securely, and treated as untouchable. Now here's the part people resist. They feel like holding 20% in cash means leaving gains on the table. But the 20% is not a cost. It is insurance. And the premium you pay is not 20% of your future returns. The premium is the difference between a calm strategic holder who rides the full cycle and a forced seller who locks in the worst possible loss at the worst possible moment. That insurance is extraordinarily cheap given what it protects. Let me bring this full circle. You came into this video wondering if you could hold through the next drawdown without being forced to sell. Now you have the answer. And it is mathematical, not emotional. 80% of your assets in Bitcoin held long-term, treated as untouchable. 20% in liquid instruments covering 12 to 24 months of living expenses. The 20% absorbs every emergency, every unexpected cost, every moment of financial friction, so the 80% never has to move. Sequence of returns risk is the real enemy. Forced selling at the wrong moment is what destroys wealth that should have compounded for decades. The 80-20 rule is your answer to that enemy. The most prepared investors in this space are not necessarily the most bullish. They are the most structured. When Bitcoin was trading near its cycle low in late 2022, the people buying more were not lucky. They had engineered their finances so no external crisis could force their hand. That is not luck. That is architecture. You are not just a Bitcoin holder. You are a capital allocator building a system, not placing a bet. That distinction is worth more than any single trade you will ever make. If this kind of strategic thinking is what you want more of, subscribe. Every video here is built for investors who make decisions based on math, not emotion. You have the system. Now build the buffer